The stock market can seem like a complicated thing, but it's not as scary as it sounds. Basically, it's a place where you can buy and sell pieces of companies. These pieces are called stocks. Think of it like buying a slice of your favorite pizza place. When the pizza place does well, your slice becomes more valuable. The stock market is like a giant marketplace for these slices, but instead of pizza, it's companies. The stock market is important because it lets companies grow and create jobs. It also lets everyday people invest in these companies and potentially make money. So, it's a win-win for everyone. People invest in stocks for several big reasons. Investing in the stock market can be a powerful way to build wealth over time. Unlike traditional savings accounts, which offer relatively low interest rates, stocks have the potential to provide much higher returns. This potential for growth is one of the primary motivations for many investors. One reason is that they hope to grow their money faster than they could in a savings account. Savings accounts are generally considered safe, but the interest they offer often doesn't keep up with inflation. In contrast, the stock market, despite its risks, has historically provided higher returns over the long term. Stocks have the potential to increase in value over time, meaning your initial investment could be worth more in the future. This appreciation in value can significantly boost your overall wealth. For instance, if you invest in a company that grows and becomes more profitable, the value of your shares in that company can rise accordingly. Imagine buying a share of a company for $50 and watching it grow to $100. This kind of growth is what attracts many people to the stock market. It's the potential for substantial returns that makes investing in stocks so appealing. Another reason people invest is to earn dividends. Dividends are payments made by a company to its shareholders, usually derived from profits. These payments can provide a steady income stream, which can be particularly attractive for retirees or those looking for passive income. Some companies share their profits with their shareholders, and these payments are called dividends. Dividends can be reinvested to purchase more shares, further compounding your investment returns over time. It's like getting paid just for owning a piece of the company. This additional income can be a significant benefit, especially if you hold shares in companies that consistently pay high dividends. Finally, investing in the stock market can help you stay ahead of inflation. Inflation is the rate at which the general level of prices for goods and services rises, eroding purchasing power. Over time, the prices of goods and services tend to go up, which can erode the value of your savings. By investing in stocks, you have the potential to achieve returns that outpace inflation, thereby preserving and even increasing your purchasing power over the long term. Stock prices might seem like a mystery, but there's a simple explanation behind their ups and downs. At the core, stock prices are driven by the basic economic principle of supply and demand. The price of a stock is determined by supply and demand. This means that the price of a stock will rise or fall based on how many people want to buy it versus how many people want to sell it. When more people want to buy a stock than sell it, the price goes up. This is because buyers are willing to pay more to acquire the stock, driving the price higher. It's like a popular toy during the holidays. Everyone wants it, so the price goes up. The higher demand for the toy makes it more valuable, and the same principle applies to stocks. Conversely, when more people want to sell a stock than buy it, the price goes down. Sellers are willing to accept lower prices to offload their shares, causing the price to drop. Think of it like an old toy no one wants anymore. The price will drop so the seller can get rid of it. The lack of demand makes it less valuable, and the same happens with stocks. Many factors can influence supply and demand, including company news, economic conditions, and even investor sentiment. For example, positive news about a company's earnings can increase demand for its stock, while negative news can decrease it. Economic conditions such as interest rates, inflation, and employment rates also play a significant role. When the economy is doing well, people are more likely to invest in stocks, driving prices up. Conversely, during economic downturns, people may sell off their stocks, causing prices to fall. Investor sentiment, or how investors feel about the market, can also impact stock prices. If investors are optimistic, they are more likely to buy stocks, pushing prices up. If they are pessimistic, they may sell stocks, driving prices down. Understanding these factors can help you make more informed decisions when investing in the stock market. By keeping an eye on supply and demand, company news, economic conditions, and investor sentiment, you can better predict how stock prices might move. Ready to dip your toes into the stock market? Great. The first step is to open a brokerage account. A brokerage account is like a bank account for your investments. You can open an account online in minutes with a brokerage firm. These firms provide a platform for you to buy and sell stocks and other investments. When choosing a brokerage firm, consider factors like fees, account minimums, and the types of investments offered. Don't be afraid to shop around and compare different options to find the best fit for you. Once your account is open and funded, you're ready to start investing. Section 5. Choosing your investments. Now comes the exciting part, choosing which stocks to buy. But with thousands of companies to choose from, it can feel overwhelming. Don't worry, there are ways to narrow down your choices. First, think about your interests and what you know. Are you passionate about technology, healthcare, or renewable energy? Investing in industries you understand can give you an edge. Next, research different companies within those industries. Look at their financials, read news articles, and consider their future prospects. Remember, you're buying a piece of a business, so choose wisely. You can also seek advice from financial advisors or use online resources to help you make informed investment decisions. Section 6. Diversification. Don't put all your eggs in one basket. You've probably heard the saying, don't put all your eggs in one basket. Well, the same applies to investing. Diversification means spreading your money across different investments to reduce risk. Think of it like this. If you put all your money into one stock and that stock performs poorly, you risk losing a significant portion of your investment. However, if you diversify your portfolio by investing in a variety of stocks, bonds, and other assets, you can cushion the blow if one investment doesn't pan out. Diversification is a key strategy for long-term investment success. Section 7. Risks and rewards of stock market investing. Investing in the stock market, like any investment, carries inherent risks. These risks can be daunting, especially for new investors who may not be familiar with the complexities of the market. It's crucial to approach stock market investing with a clear understanding of what you're getting into. It's important to understand these risks before you invest your hard-earned money. By educating yourself and staying informed, you can make more strategic decisions that align with your financial goals and risk tolerance. One risk is market volatility. The stock market is often compared to a roller coaster because of its unpredictable ups and downs. This volatility can be caused by a variety of factors, including changes in interest rates, inflation, and investor sentiment. Stock prices can fluctuate significantly in the short term due to factors beyond our control, such as economic recessions or geopolitical events. These external factors can create a lot of uncertainty and can lead to significant losses if you're not prepared. Another risk is company-specific risk. This refers to the potential for a particular company to experience problems that negatively impact its stock price. These problems could be due to poor management decisions, product recalls, or other issues that affect the company's performance. Even if the overall market is doing well, a particular company you've invested in could experience setbacks that negatively impact its stock price. This is why diversification is so important. By spreading your investments across different companies and sectors, you can reduce the impact of any one company's poor performance on your overall portfolio. However, along with the risks come potential rewards. The stock market has the potential to provide significant returns, especially if you're willing to invest for the long term and ride out the market's ups and downs. Over the long term, stocks have historically outperformed other asset classes, such as bonds and cash. This means that despite the short-term volatility, the stock market has been a reliable way to grow wealth over time. This means that investing in the stock market can help you build wealth and achieve your financial goals. By understanding the risks and rewards, you can make informed decisions that will help you navigate the complexities of the stock market and work towards a more secure financial future. Section 8. The importance of research and patience. Before investing in any stock, do your homework. Research the company thoroughly, understand its business model, and analyze its financial health. Don't rely solely on tips or rumors. Instead, focus on making informed decisions based on solid research and analysis. Remember, knowledge is power. Just as important as research is patience. Investing in the stock market is a marathon, not a sprint. Don't expect to get rich quick. Instead, focus on the long term and ride out the market's ups and downs. Section 9. Conclusion. Take the first step towards financial growth. The stock market can seem intimidating at first, but it's an accessible avenue for anyone to grow their wealth. By understanding the basics, choosing investments wisely, and staying patient, you can navigate the market with confidence. Remember, investing always involves some risk, but it also offers the potential for significant rewards. Start by learning as much as you can, and don't be afraid to seek guidance from financial professionals. Take the first step towards financial growth by exploring the exciting world of stock market investing today.